Dr. Raghuram Rajan is Eric J. Gleacher Distinguished Service Professor of Finance at the Graduate School of Business, University of Chicago. He is the chair of the Committee on Financial Sector Reforms, Government of India. He has been was actively involved in the setting up of the center also, Center for Analytic Finance. We have close connections to Dr. Raghuram Rajan, and it's indeed a pleasure to have him with us.
I think what we've seen today in the various talks is basically there's tremendous capacity for growth directly within the financial sector, but also the financial sector itself could contribute to the growth process by allocating resources better and by managing risk better. So both directly and indirectly, there could be tremendous growth. The kinds of jobs that are available in the financial sector are high value-added jobs, and these could be very beneficial for the young generations that are coming out, including many from this place. However, there are weaknesses in the financial sector, and this could hinder the long-term objectives of growth, inclusion, and stability, and this is why we need reforms. And the committee that I chaired has proposed reforms which we hope will be implemented within a 5-year framework and will help this process. Now, what are the reasons why reforms are important? You saw from the previous panel one reason. One reason is greater inclusion. By inclusion, we must remember we're not talking just about the poor. The median Indian household is actually an excluded household from many perspectives. It doesn't get access to financial services. You heard some statistics bandied about. But one statistic that I find particularly interesting is despite our focus on credit, the whole nationalization process was an attempt to send credit to the sections that had been missed out. Despite that focus, in a recent survey, and I think one of the gentlemen in the previous panel suggested that things had improved. They haven't. The most recent survey of financial habits of households suggests that the median household borrows 75% from informal sources. Only 12% of its borrowing is from formal sources. So this is appalling. It's suggesting that the median household doesn't really have any access to financial services. This is for credit. I mean, it's also true of savings accounts. Despite the RBI's attempt to get universal savings accounts, there's been a lot of talk. Action is going on, but too little. At the rate at which, even if we increase 3 or 4 million accounts a year, to get accounts to every household will take 25 to 50 years. That's too long for people to wait.